Tim Quast is the founder and CEO of Market Structure Edge. What is that hand thing? Tim, good morning.
Good morning.
It's a good
morning,
tune.
guys. I'm doing the V for vaccinated.
Hey,
I hope that.
Did you do the J&J?
I hope the spot that Spock didn't copyright that. So Dennis, we walked into the pharmacy for shot number 2, and I walked up to the pharmacy and I said, "We're here for the J&J shot," and it did get a little burst of laughter. No, we did the Pfizer version.
The Pfizer's been the best one. I want the Pfizer shot too, but I don't even have any choices in Canada, so I'll take the J&J, man. Send me your J&J shot. I'll take it right now.
Come down to one of my houses, and we'll hook you up.
I know. I should come down. Bring your J&J shots to Ontario. We don't have any shots. We'll take AstraZeneca. We'll take the J&J. We'll take the Pfizer. We'll take your homemade vaccine. We need anything in Ontario, man. We just want to get out of lockdown.
Right. Well, come on down. Come on down to Steamboat.
I should. They don't let me in the country, though, because I'm from Ontario.
Yeah.
You got COVID, man. We just stay away.
Right.
Tim, how's it going?
Well, thank you. I heard I've heard part of your discussion about Peloton and Tesla, and Joel, I've got a Peloton as well, and it is a great machine, isn't it? They're just fabulous machines. So the question, though, I suppose, is whether that's material. From a trading perspective. And I watched some of the folks. See, you've got a big crowd, and I watched some of the comments before I came on, and it might be interesting to look at Peloton. There are some things that I think we should talk about. Maybe I'll preface it this way: there's the big picture, and then there are these specific cases. It's probably good to review. If we look back to it's not me. We have good data. I think that Market Structure Edge has good data. We go back to January 25th when I was on with you right before I left for the Caribbean. As we said, well, the data show that the market's probably going to decline, and it'll do that for about 10 days. And then we came back in February, said, well, now the market will probably recover until the February expirations and the month-end window dressing jam into each other, and then we're probably going to have 10 days of trouble. And sure enough, we did, right? Then we went into March expirations, and there were very strange occurrences that happened there. And we can look at some of that if we want to, but the point is that's where the Archegos Capital blow up occurred. And following that, we said, well, I think tech probably is the place to be, because if tech, which will bring us back to Peloton in a moment, is 50% of market cap. So the FANGs Plus, I include in that group AMD, Tesla, of course, Microsoft, NVIDIA. I throw in Shopify because of its characteristics. So if you add those together, it's 22% of market cap, just in the FANGs and the Plus group. Then you add tech that is in consumer discretionary, which includes Facebook and Netflix. I saw some folks were talking about Netflix, and then communication services, and then tech itself. It's 50% of market cap. So if you have a market where assets are allocated, even if Kathy chooses a basket, she will not be able, obviously, that's her focus to begin with, but she's going to come back to the names that matter because they're most of the market. And that's true for just about anybody. And sure enough, that group did well. And we said probably they do well right into April options expirations. And Joel, I think that's your answer to Tesla. It wasn't an upgrade. It's because Tesla did well right into Thursday, Friday, index futures expirations on Thursday that the Europeans prefer. It's our only AM dated instrument in the American markets. And then Friday was triple witching, stock and index options, and then options on futures. That's the triple. And the markets got a nice run into that. Now the broad question is, what happens with new options trading today? And folks like Millennium, 50 billion in under management, huge hedge fund run by Israel Englander. And and traders, when you look at these folks like that, the professionals, the big hedge funds, it's not that they have 50 billion, it's that they will have 450 billion, because they tend to lever 8 or 9 times to 1. And Israel Englander is hiring a bunch of risk management people out of Goldman Sachs. So is Millennium. And what does that mean? Are these folks concerned about the effect on banks? Spencer, you and I traded notes about banks, and why are the banks not doing so well on these incredible results that they've achieved? Goldman Sachs has done fine, but the others have kind of lagged. All of that brings us around to let's start with Peloton. That's the backdrop to me, and it tells me that using probabilities and data are wise, and that if hedge funds are thinking about hedging risk and new options trade today, what should we as traders take away from that? And are there some data and probabilities that we can use? So I've rambled on, but traders, I'll share this with you.
Let's jump into Peloton.
Yeah, let's look at Peloton. So I'll share my desktop, and traders, you can do this. Just go over to marketstructureedge.com. And you can sign up for free and just follow along. And I'll show you how simple it is to look at the market structure data. By the way, for fun, I was reading the 898-page new rule on the data plans over the weekend. That's what I,
That was a nice weekend. I just started reading 900 pages on the new rule on data.
It's riveting. That's some. There's Stephen King, and then there's the data plan discussion from the SEC. Of course, all the exchanges have sued the SEC to block these changes. But anyway, here it is. So the app is actually app.marketstructureedge.com, but just go to marketstructureedge.com and this is what we look at. So let's go look at Peloton from a market structure lens. And what that means is the rules that govern how the market works and the behaviors that arise from that. So if we look at Peloton, it's 10 out of 10 overbought, topped, 60% short, and machines are the leading behavior. That was as of Friday. So no surprise that it would be down. I mean, it's at the very top. You don't want to buy top sentiment. You don't want to buy tens. You want to buy sentiment that's rising. So traders, if you want to know when to come back to Peloton, the data will tell you. The time to buy Peloton was right here when sentiment began rising. So that was right at the end of that particular day was March 25th. So right at the end of March, this is where money started to re-weight back into tech. And notice that sentiment, this is the line. The thing I love about sentiment is it's not volatile. Prices are very volatile. It's very difficult to trade a price because it changes all the time. So sentiment just rose and rose and rose and rose until it hit 10. Short volume right here it's very high. It's frighteningly high. It did tick down. It was actually a little squeeze on right into options expirations, probably telling us that there were puts and people got squeezed on those puts. And the offsetting hedge would be short volume. So that hedge comes off. So even here, if you held it, you would hold it. If you don't own it, don't buy it here. This is not the time to buy it. You want to buy it when this line has gone all the way back down and begins to recover again, telling you that everybody who's going to wash out is out and demand begins to come back, then surf that wave. That's how you do it.
Tim, can I hop in here real quick for a second? Does it come down and then go up a little bit and then come right down again?
Rarely. It usually runs in cycles, right? If there is weak demand, it does not rise back above 5. 5 is the axis. I always think of the market as being, the 10-point scale. And if things are above 5, there is more demand than supply. Since the financial crisis, by the way, all the way back to the recovery, March of 2009 to present, the market has averaged, even through the pandemic correction, about 5.5. The whole market. So it tells you the whole market is a GARP, growth at a reasonable price market. When, and it will happen, it stops averaging 5, that's when we will really have a sustained bear market. And we're nowhere close to that. But notice that Peloton here in February never got back above 5. It just never, you could still trade it there, but you would want to leave. If it stays at 5, get out because it's not going to do better than the market. And so you want to own stuff that will do better than the market. And it really did very poorly. This was a tough time. This is the Archegos effect. Everything wigged out around that Archegos effect. But notice how it tends to rise and fall predictably. and that's what you want to use.
Let's go to Tesla too, because it's in the news here. Obviously, it's down significantly here this morning, but it was starting to show life. It's been holding on so much better than some of the other high valuation names. Tesla's actually, maybe it's because it's such a major S&P component that just kind of moves around with the S&P. The index effects probably have significant more effect than maybe the whole high valuation with sound high value stuff. So anyways, down 19, obviously, accident, tragic over the weekend.
Right.
What is the market structure looking like on Tesla?
So, and by the way, with roughly, let's call it 750 billion in market cap, Tesla by itself, if total market cap is 50 trillion in the U.S. market, it's a mind-boggling number, 50 trillion. Tell
us about that. How are you calculating that?
So you take roughly the Russell 3000. You take the Russell 3000, which is 99.9% of market cap, and you add it together. And you add that up, and we're at just barely shy of 50 trillion in market cap. But Tesla is a meaningful part of that by itself.
Yeah.
At 1 trillion, it would be roughly 2% of the market. So it's just a shade under 2% of the market. It's huge. Yeah. And so look at it too. 10 out of 10, topped, 41% short. It's more long than short. That's a pretty good sign. Active money is the lead behavior. So really, investors continue to believe, thinking people continue to believe in Tesla.
So this could be a buy the dip opportunity?
Well, again, the rule still applies. If it's 10 out of 10 and short volume covers, if you own it, don't leave. You don't have to leave. This tells us that this effect is likely to be short-lived. Now, if it changes, if short volume rises above trend, like we saw in here, this is where you would wait. So you wait for, sentiment returns to the trend, and short volume, returns to trend. Short volume, by the way, traders, is the amount of stock comprising daily trading volume that is borrowed. And it's almost half. So when it reverted to trend here and sentiment ticked up, well, that's a great time to buy it. And then you stay until sentiment ticks down or reverts to 5. So in here, if you own it, stay. You don't have to sell it unless the data tell us. If you want to buy it, I would wait. I think that once again, you have two important dates here that are occurring. Right now, we're still in April options expirations. New ones trade today. Tomorrow, banks will true up their books on both the ones that expired Friday and these new ones trading today. Wednesday is VIX expirations. And there are trillions of dollars tied to volatility strategies to avoid it or to ride it. And so you get past that and we can see some big changes in the way that people are trading. So wait again for sentiment to fall and rise. You will get another better entry point, and it may come after this. And how long would it take? Well, data tell us that it takes, if you look at the cycle here, it's about 8 or 10 days. 8 or 10 days and you'll have an opportunity, I think, in Tesla.
T. Cole says he never misses Mondays with Tim Quast.
Thank you.
He is the founder and CEO of Market Structure Edge. Joins us every Monday for Market Structure Mondays. Tim, always a pleasure. Nice view behind you. You're in a different spot.
Good view.
We like it. We'll talk to you next week.
All right, guys. Have a great week. We'll see you.
All right.
Thanks, Tim.